For buyers who want to lower their out-of-pocket at closing, asking the seller to pay closing cost is a great strategy. And I'm seeing it more and more as our market starts to shift to a more balanced, or even in some cases, a buyer's market. But it doesn't work for every scenario because maybe the seller doesn't want to. Maybe it's a multiple offer situation and the buyer doesn't want to run the risk of losing the house over several thousand in closing costs. Or maybe there's not enough room in the sales price and what the seller wants to make to pay for the closing costs. So what do you do then? I'm Rebecca Richardson, aka the Mortgage Mentor, and this channel is here so I can share everything that I know about mortgages to help you make smart real estate decisions. So recently I had a really cool situation with one of my VA clients, and they were using their VA benefits to purchase another home, 100% loan to value, so no down payment. And although they did have money for closing costs, they wanted to know what they could do to minimize their out-of-pocket costs. They had some other projects, some other financial goals going on, and they just wanted to see how they could, make it all work. So they found this great house and it hadn't been on the market long. They didn't want to run the risk of asking the seller to pay closing costs and not winning the home. But at the same time, they were again trying to balance out either asking the seller to pay or them having to pay. But there was a third option that worked out better all around. And what you can do as a buyer is just like how you can pay points, so basically more closing costs to buy down your rate, to lower your rate from a market rate, you can opt for a higher interest rate. Now, why would you do that? Because with a higher interest rate, it actually gives a credit. It will give the lender more credit back on that loan when they sell that loan. So what they do is then pass that on to the buyer as a lender credit to offset their closing costs. So in this situation, closing costs were around $15,000. And looking at either what is called the par rate, and that's the rate, if you kind of picture in the middle of what rates are, right at the center is what's called the par rate. And that means you're not having to pay points to get a lower rate, but you're also not opting for a lender credit that's associated with a higher rate. So it's kind of a seesaw thing, or if you think about it, kind of like a bell curve. That's essentially how to visualize it. But in that case, the par rate, the difference between the par rate and then a rate that was able to cover the majority of their closing cost was only about 0.75%. And that sounds really dramatic, right? Because always, whenever we're financing anything, we want the lowest rate. And I agree with that. But in this case, the trade-off for them made sense because they were able to cover their closing cost and only had to pay about $275 more a month. And why this works is because it leaves the option for them to later refinance. And yes, they will have closing costs on a refinance, but the closing costs will be lower than they would be on a purchase for them. And they have the ability to roll those closing costs into the loan, so they're not having to come out of pocket. Since about every $10,000 difference in loan amount is usually only around $50 to $60 a month, if the priority is to keep your nest egg, to keep cash, then this is a good solution to, as long as the mortgage payment makes sense for you. But this can be a good solution for a way to cover those closing costs since they can't be financed into the loan. And that's where I think that coming up with a good plan of that it's not just sometimes right now what you need to buy the house, but let's look at the bigger picture, right? It's not just what's the lowest rate, what are the closing costs, but how much money do we have to play with here? Do you want to do that towards closing costs? In some situations, do we want to ask the seller for a seller concession or for the seller to pay the closing cost? Does that put you at a negotiating deficit, right? Is it going to potentially make it more difficult for you to get the home? Then what else can we do? In that case, sometimes opting for a higher interest rate does make sense. Because again, with a purchase, you can't exactly finance closing cost, but by using a lender credit, it does allow you to pull a different lever that isn't money coming out of your pocket or coming out of the sellers. So the right answer does depend on your file specifics, loan type, what rates are doing at the time, and what your goals are. But at least knowing that this option exists does help when you're thinking about how to structure the offer and what your approach is going to be. So as always, comment with any questions. I am here to help, and be sure to subscribe for more information. I'll see you next time.